Okay, all right. Ekta, thank you very much for that. Let's straight away get to the first corporate on trading hour then. Narayana Health has delivered a good second quarter. The company has posted a revenue growth of more than 20% on a year-on-year basis. Margins too have improved both sequentially and on a year-on-year basis. To discuss the quarter gone by, the outlook going ahead, we are now joined by Sandhya J, the Group CFO of Narayana Health. Good morning and thank you very much, ma'am, for joining in. Let's talk about the India business, which has seen about a 19% year-on-year revenue growth. Could you tell us what were the occupancy levels, the average revenue per occupied bed, and what is the outlook on these two parameters for the second half?
Sure. Good morning, and I really like the way you said good morning, girls. And starting with the India business, I do want to clarify that we did have some one-timer impact in the India business. So there is about 1.5% to 2% impact in the EBITDA because of the one-timers. We have clarified that in our results also, but just from a clarity point of view. Having said that, I think the first is, like we have always said, we look at revenue per patient as a better measure than looking at, ARPOB, because we feel that the patient communicates with the healthcare organization in multiple ways, and everything is not bed-driven. If you look at our average revenue per patient, it has been similar to Q2, if you would say. But I think where we have got the benefit or the tailwind is that one, we've been able to significantly improve the footfall and the case mix. We have also been able to improve the payer mix and the throughput with the patient. So that I think has given us the benefit. Now, from a utilization point of view, normally healthcare utilizations are around 60%. That's how they get reported, and we continue to be always in that range, 55 to 60%. But again, we need to understand that utilization as a metric does not really take into account some of the daycare volumes. See, we do more and more advanced procedures. A lot of robotic procedures is a morning walk-in, evening walk-out. So the way we look at utilization and some of those metrics is also evolving. But I think we've been able to deliver a better throughput. As you know, we've not added too many beds. So we've been able to do a better throughput in the same infrastructure.
But ma'am, if your case mix is improved, the throughput is improved, should it not result in higher average revenue per patient? Because you said that is flat on a year-on-year basis in Q2.
Yeah, that is true. So what also happens is that, see, the way we work with volumes with patients, and we are extremely conscious in what we charge to our patients. So from that part, we have always been able to create more value for our patients, more services, more enablement within the same, payment that they make. So it also is a reflection of some of the efficiencies we are able to make available to our patients.
Sandhya, hi, good morning. The hospital revenues, right, overall for the industry were expected to go up in this quarter purely because electives have improved. Medical tourism is expected to come back in a big way. So I'm just trying to understand going forward, the average revenue per bed as well as the occupancy, what could the rate be since there has been such a big pickup in demand?
Sure. So I think we have to wait a couple of quarters to give a guidance on the average revenue per patient, because there is significant pressure on the cost side. There is tremendous volatility from the cost point of view. One is, of course, the currency is playing a major impact, and we are aware of that already. But also there are delays, supply chain disruptions, which the healthcare organizations are battling with. So we also are going through our pricing exercise at the moment, and we try our best not to pass on the impact of such cost escalations to our patients, and try to keep our prices as affordable for our patients as possible. But we have to see how that impact actually takes effect to be able to give a forecast on the how the revenue per patient will move up. Obviously, you will have the effect, like you said, the effect of better volume, better throughput coming through. Some of it we will pass on back to the patient, and some of it you will be able to see in the numbers. But I am not seeing that number significantly go up, at least in our case, because we believe in value for the patient as much as for us. So that is the first aspect. The second question was on utilization, right? So on utilization, like I said, there will be two parameters. One is that we are investing significantly in digitization, and that has started giving us a lot of results in terms of how fast we are able to discharge patients. One of the reasons why utilization numbers also come in a little lower is because the turnaround at which we are able to churn patients and bring them and is linked to various factors, some of it internal, the processes in the hospital, some of it external, like approvals from insurance, PPA, etc. So we've been working significantly, we're working very hard and significantly cutting down the timeline which takes internally for the patient discharge. We have digitized the entire workflow of the patient discharge.
We got that. Sandhya, we're just trying to get to some numbers here. We got that. If you can, help us with the margins, because in spite of all of the cost pressures that you are mentioning, your margins did improve to 6.5%. So I want to know, A, what kind of levels can we expect margins to be at going forward? And also if you can take us through a breakup of what the mature businesses are looking like, as well as the new hospitals, if you can break that up for us as well.
Sure. So first is in terms of the margins, I think there is about a 2% one-timer effect in the margin, like I explained. We were able to successfully renegotiate some of our contracts, which gave us some one-timer effect because of the accounting entries. So that is not sustainable. It will not repeat. Secondly, if you remember in Q1, we had reported a weak result in our Cayman business because Cayman was going through a COVID wave in Q1. And because of that, we had a shortfall in revenue and consequently in margin in Cayman, and that came back. So some of that effect is there in the baseline. Q3 is for all healthcare traditionally a slightly weak quarter because of the festival seasons. Like in October itself, we had Navratri and we had Diwali, and these are lower volume time for healthcare. So we will definitely see some slowdown in Q3 from the highs of Q2. But a lot of the improvement which has come in the margins, the underlying numbers are sustainable. So I do think that maybe, I don't want to put a forward guidance, but roughly half of the improvement probably is sustainable. Half of it is there will be seasonal impact and the one-timers will go away. As far as the new hospitals are concerned, in the last quarter, Q1, our new hospitals had turned EBITDA positive. Now we continue to be EBITDA positive in the current quarter. The new hospitals have delivered north of 8% in terms of EBITDA in the current quarter. And I think we will build on from here, subject to the quality impact.
Sure. We've actually run out of time, but thanks a lot for joining in and speaking about Narayana Health. All the best for the quarters to come. That's the word coming in from Narayana Health. But let's do one thing. Let's slip into a quick break. Up next, we'll discuss the massive carnage in the commodity space, especially in cryptocurrencies. More on that coming up with Manisha Gupta. Stay tuned.